Hello and welcome to the Weekend Investing Daily Bite of 27th of June. And something very remarkable is happening in the markets. Nifty continues to move on, has climbed Mount 24,000 today. The rest of the market is very, very sluggish. I mean, this has not happened in a long time that Nifty continues to move on, but the rest of the market remains stagnant. And this may be a sort of the last hurrah, if you may say, for this season. Maybe Nifty is being propelled uh, on stocks that have not done well so far, and the rest of the stocks that have done well so far are, you know, sort of struggling to find reason to go up higher. The flows are also not, helping. Um, but nevertheless, the market is making new highs, and we should be happy about that. Um, so let's dive in. The first The main sort of thesis that we're going to discuss today is misleading forecasts, how these are, creating narratives in the market which cause people to do some actions which really harm their portfolios. So we should be informed about it. We will talk about this towards the second half of the session. First, where the markets are headed. The markets are headed strongly upwards. Nifty again up 0.74%. Up. It opened soft, but through the day it just kept going on. Maybe it was the expiry impact. Uh, but four strong upward candles after a plethora of uh, you know sluggish ones uh, does of course mean that buying is back. Now FIIs who were strongly short at this point of time are now strongly long in terms of their open interest. So they've gone completely from one end of the spectrum to the other end of the spectrum. Having them short in the market was a cushion to the market, and now having them on the extreme long side is somewhat of a risk on the Nifty front. But so far so good. At an all-time high, you really can't complain. Nifty Junior flat. It was actually down during the day, but in the last half an hour or 1 hour, it recovered back to close at 0.15%. So nothing to talk about, but consolidating here, and that is fine as well. In terms of mid caps, again, total doji day. Doji is a day where open and close are at the same level, and the market travels during the day. So a doji day is essentially a confused, indecisive market. Uh, it is also sometimes, in Japanese candlestick terms, a higher probability that the market will now change direction because it is absolutely evenly poised in terms of where it wants to go. Nifty small caps slightly weaker than mid caps and other indices, minus 0.5%, but well within this range that we have established. Of course, small caps were the ones which traveled the most since the election bottom day. Bank Nifty slightly on the red, minus 0.11%, nowhere going in terms of neither on the upside nor on the downside today. And this was coming after 3 days of fantastic gains, so maybe a profit taking or a consolidating day here today. So market is definitely portraying that it is overstretched and it needs a significant rest. That seems to be the message that is coming out of the market. The sectors are rotating each time. So today the sectors that were in play were IT and cement, and to some extent steel also. Uh, IT stocks, Infosys, TCS, Wipro, all doing extremely well. Ultra Semco, on news of investing into India Cements, also jumped up 5%. JSW Steel and Tata Steel also doing well. NTPC jumped up 3.3%, and Tata Motors was up 2%. Reliance also up 1%. Bharti up 1% on the mega spectrum win that they did. Then Nifty next 50 heat map, again you can see Siemens, ABB, Motherson, Bosch. These are sort of regular gainers now, almost gaining on a daily basis here. Adani Green did very well. Gas Authority and Tata Power did well. REC did well. SRF did well. And Havells, Godrej CP, LIC Geo Finance, PNB lost some ground today. So mixed bag, but reasonably evenly poised out. Yesterday, DIIs bought in a big way, 5,000 crores. FIIs sold 3,500 crores. So again, FIIs have been on a reasonably, long selling spree. Just one day of good buying that had emerged 2 days back. But other than that, since the last week, no other buying day from FIIs. DIIs, of course, are putting in significant amounts of money. Sectoral trends, IT leading the pack at 2% for the day. IT has made a good comeback with 6% for the month. Commodities up 1.3%, energy stocks 1.3%, infra up 1%, Nifty also gaining 0.7, autos 0.7, public sector enterprise also 0.7. So large number of sectors were actually in the green, and most of them actually came into the green after the first half. Uh, Real estate still down 0.1, pharma down 0.2, PSU banks losing the most at 0.9% now for the month, 2.1% down on PSU banks. Bank Nifty overall also down 0.1%. So what has done the best in the last month? It has been private banks at 8.1%. You had IT, you had real estate, and Bank Nifty, of course, behind private banks. So these are the few of the gainers of the last 1 month. What has trailed in the last 1 month is public sector enterprise stocks, PSU banks, and metals. That and all three of them were actually doing very well in the months before that. Nifty IT index has again sort of broken out, looks good, as a wide sort of a breakout continuation of this strong move that had started here. So there is potential of much more upward move here, plus 2% today. And commodity index is also now coming back to the election day high, has not yet crossed that. So it is lagging the rest of the market, but at plus 1.34%, doing quite all right. In terms of stock spotlight, India Cements gaining a lot of ground today, 11% on Ultratech some approval of acquisition of 23% in India Cements. But I want to point out some market games that have been going on here. So today the board meeting was there at 8:30 a.m. On 27th June, and it was decided by Ultratech board to acquire 23% in India Cements, and the stock jumped up. But just look at what was happening yesterday. This is the chart of the 26th of June. Ideally speaking, nobody should have known about this transaction yesterday, but India Cements, right from the very start of the 26th, was jumping with great volume. Just see the previous day's volumes and then the volumes on the 26th. So interested parties knew that a deal is happening at 200 and whatever 60 70 rupees, whatever is the rate. So it was already primed up to that 260 levels, and then of course once confirmation was there, another jump up was there. So is uh, uh, this is something basically that the you I mean, if you're doing something wrong in the market, you really can't hide it, because price action is something that you really can't hide it under any mattress. So it is very, very abundantly clear that front runners have done their tasks yesterday. Who was benefiting, I don't know, but this is something that should be looked into. Anyhow, so this is the reality of the markets. The front running concept that I talked about a couple of days back also is a real problem of the market, where genuine transactions, when they're getting done, there is a lot of front running that is done ahead of that transaction, and due benefit to due folks does not really accrue because of this kind of activity. Gold is moving up slightly, 0.5% up. It's at 71,380. Gold has been consolidating here. This is the support below which, of course, gold will go down dramatically. On the US dollar gold chart also, there is a potential head and shoulders pattern that can go towards 2150 if 2300 is broken decisively, but we are still right there. And if we cross the 7300 here, then there's good potential of the reverse cycle starting out. So the topic for the day for discussion is misleading forecasts. Now, I'm not trying to uh, be negative about anybody making a forecast, and the names that I will showcase here are just for example purposes. But the fact is that 99% of the people in the market want to forecast. It is a kick that a lot of people get, that I was able to say that Nifty will go here and it actually did. That kick is much bigger than actually riding the Nifty and making money on it, it seems. So 100 people that you will meet in the market, 99% of the people will give you some kind of a forecast even before you ask for it, or they will ask you for your forecast, that what do you think the market, where it is going. So everybody is wanting forecasts, and if you open the television, entire day, every 5 minutes, there is a forecast that is being given on the television by numerous channels. You know which ones they are. And if you were to audit all of these forecasts, if you make a list of all forecasts given by all the intelligent analysts and managers who come there, I can bet you 85% of them will go wrong. And the reason is that most people will have a lot of recency bias. So any stock that is running, the target will continuously keep moving up. Any stock that starts to come down, the target keeps coming down along with it. So price is always leading many of these target setters. And in our case, of course, we follow the market and we consider the BBC principle, Bhav Bhagwan Che, as our leading. Uh, the way we think about the markets is that the market is supreme, and everything that is to be known about a particular stock or a sector or the market is already getting discounted in the market, and hence you can just follow the trends and the market will lead you to wherever it is going. And once it stops to go any further up or down, it will also tell you that it's not going up or down. So even if you were to not forecast, so if you don't forecast at all, even then you can make significant returns from the market, and that helps you in the way of not having any expectation. So I have no expectation that markets will jump so much by so much time. I'm saying I'm following the market. I know that we are in a growth trajectory. We make 12%, 13% on a long-term basis on the index. Uh, we are able to extract alpha from the index. We'll add significant more alpha on top of that index return. So our nominal returns will be significantly higher than that, most likely over a longer period of time. Some years will be great, and some years may be okay, and that's fine. I mean, I don't need to actually make any target, any forecast, anything about any stock. So just for instance, and I'm again saying these are just examples. I'm not trying to demean these intelligent folks here. September 2023, this research house comes out and says we are stopping recommendations on mid and small cap stocks. There is too much exuberance, and you know according to them they are priced out completely. And this is September 23. We are now sitting in June 23, and you know what has happened between September 23 and June 24. Has the fund house liquidated their small cap funds and returned the money? No. So this is essentially, I'll have my cake and I'll eat it too. That kind of syndrome, that I'll keep making money from people who invest in small caps with us, but I'll also keep saying that small caps are too expensive. That kind of syndrome. Then there's another kind of advice that is given out, that we will underperform for some time, but then we will overperform. So if you are a very short term player, then of course don't come in, but if you are a slightly longer term player, everything is fine. So you essentially cover your bases on all sides, and still have your products getting sold there. Another one, like, for instance, small cap segment can suffer more time to avoid the sector. A lot of experts had given their views here, many of them, and this is March 2024. Again, saying that it's very expensive and it's very expensive, but nobody is liquidating their funds. I mean, any portfolio fund manager, any mutual fund manager, have they said that no, everything is very expensive, we should get out of this market? So there is gap between what people are speaking and what they are actually doing. And this, since September 24, you can see how mid caps have performed and how small caps have performed. And they may be expensive from traditional perspective, from the conventional earnings perspective or relative valuation perspective. But who can say that this irrational exuberance, if you call it, cannot continue for the next 5 years? It can happen, right? So why should we try to curtail our exposure? We can always create hedges. We can buy gold on the side and make sure that, if something really goes wrong in the market, we'll have a hedge to have some protection at least. But to really, like for instance, if you take the example of Nvidia, the stock is $3 trillion of market cap today. At half a trillion, people had said that this is too much. This can't go up any further. Then from half, it went to one, then 1.5, 2, 2.5, 3, 3.2. It is just continuously going up. And yes, at some point of time, it will fall. But these are the, you know, uh, high swings of the market that you have to participate in. If you will sit out of the market, when the market is running away, if somebody sat out of Japanese market, in 1985 and did not have that last 5 years of 5x or 6x gain, they would have missed the entire run of their life. And of course, later on it fell, but whenever markets will fall, you will have exit plans in place. So this forecasting disease that is, encompassing every mind needs to be, you should have a rational view about forecasts. And 85% of active fund managers don't beat the benchmarks. That is also a reality. So none of the forecasts are actually working. Nobody really knows how the world is going to be in 3 years' time. Nobody knew about which was going to happen last year, and nobody knows what is going to happen in next 2 years regarding, the US dollar, regarding the building tension with China on Taiwan. Nobody knows how oil is going to behave. Let's say oil may cross, three-digit mark very soon and just continue to go up to 150. I mean, our finances will get screwed, right? So, but we can't really forecast that. So a lot of things are left for, for them to happen on their own. uh, Forecasting is good if you position yourself according to that, and then not regret that, okay, I may have taken the wrong decision. But if you're not positioning yourself also, and if you're just forecasting, and a lot of people are getting influenced by your forecasts, then I think that is something to be wary of, and not do that. But if you feel that, there is a lot of build up, you made 300% and you would like to be out of the market or take some money off, by all means, of course, it is your money. You should be sleeping peacefully with your money, right? If you have exposure and you are feeling a bit anxious, then take some money off. Whenever you feel anxious in the market, it means you are overexposed. uh, Basis your expectation of the market and your comfort level. So you should always either reduce your exposure to the market or create a hedge or do whatever structuring is required, so that you can come to peace. At any point of time, you should pencil in that I can lose 20-30% any point of time. That is the nature of the market. If you are worried about 5%, 10% fall, then maybe you are in the wrong place. So from that perspective, if you have the right perspective, you will, sail through the market like a breeze. There should be absolutely no worry. Investing should be a pleasurable and enjoyable journey. The end result is not so important. This journey is important. Please understand that. Let me know your comments on this. Thank you so much for watching, and please share the video with your friends and family. Thanks. Bye.